Right now, crypto assets in total, all digital assets, are a $4 trillion market. Global real estate, 400 trillion. Global debt, 300 trillion. Global equities, 100 trillion, et cetera, et cetera. Gold, 20 trillion. Now, Bitcoin probably replaces gold. Okay, so we know where Bitcoin's going. But the rest of it is going to account for the other part of this equation. And that comes from this total market cap of the entire space. If we just use the same log adoption channel, which works in everything, and we've shown it, it tells you we get to 100 trillion in value by somewhere like 2032, if we just follow the fair value curve. So by 2032, 7 years from now, this entire space is $100 trillion.
Crypto might feel huge today, but in the bigger picture, it's still tiny. The entire digital asset market is worth about $4 trillion. Compare that with $400 trillion in global real estate, $300 trillion in debt, and $100 trillion in stocks. Even gold, often seen as a relic, sits at $20 trillion. Rawl Pal argues that Bitcoin alone will eventually overtake gold. More importantly, the whole digital asset space is tracking the same adoption patterns we've seen in other technologies like the internet and mobile phones. Those patterns suggest crypto could reach $100 trillion by 2032. In other words, what looks like a niche market today may actually be one of the biggest financial shifts in human history. Make sure to stick around until the end of the video as Rawl Pal reveals why missing this shift could be the most expensive mistake of a generation. Before we jump into it, just a quick reminder, only a small percentage of you watching are actually subscribed. If you're getting value from the videos, hit that subscribe button. It's free, it supports the channel, and you can always change your mind later. Now, here's Rawl Pal with his latest market outlook.
So take into account everything we know about debasement, that it is the massive macro factor, that it drives all assets, including the business cycle, that it's all related. So everything is correlated. So when you start to come that understanding, you start to think, what is the point of diversification? You start to think, actually, what I should be doing is using the most powerful macro variable we have ever had, literally in the history of macro. And it explains most of the price moves. So therefore, we trade that. And by trading that, we start looking for what is the asset you want to own? How do I make the most returns from this incredible macro opportunity? And we call this the supermassive black hole. This is why a bunch of macro guys like Julian and I in crypto, it's why we've ended up in technology stocks. It's this that is the key factor. And this is the mega trend that you need to be aware of. This mega trend, if you think about it, what is debasement? Debasement is scarce assets going optically up in price because the denominator, fiat currency, has fallen. But the issue that's affecting society globally is that wages and earnings are driven by GDP growth and not debasement. This is why inflation and debasement are two different things. So what we found is that earnings, household earnings, corporate earnings are driven by the business cycle and GDP growth. But the debasement drives the assets. Now, the debasement is at 11% a year and GDP growth is at 2% a year. So what you get is everybody getting poorer. The amount that their earnings buys of, whether it's gold, which is a nice pure way of looking at it, is less every year, or of real estate, or of anything, which is why house prices are so expensive now. It's all based on the debasement and the fact that it doesn't help your earnings, which is why we talk about unfucking your future, because you are so fucked if you don't have long duration assets like crypto or technology in your portfolio, because you're just not getting ahead. In fact, you're really hampering yourself. So we'll come on to a bit more of that in a sec, because it is the key killer point for you guys and unfucking your future. And while you feel that the world is running away from you and you can't catch up. So when we look at NASDAQ versus total liquidity, so this is the outperformance of NASDAQ versus total liquidity. we can see that it's been doing about 13.8% in excess returns. So you've been handsomely rewarded by NASDAQ. Why? Because tomorrow is going to be more digital than today. So many people are so stupidly scarred by 2000, when this has been the greatest bull market in history, is the NASDAQ, going back to 1985, 1990. And yet people still miss it because there was once a bubble that burst. But even then, returns have compounded massively over time. So that looks good. We understand technology investing. We understand the rise of these new giants. We're seeing the change from the internet world to the AI world. That's driving excess returns again. But when we think of Bitcoin, it's actually driven 94% a year excess returns over the rate of debasement. So you've got this asset that is in la la land in returns versus anything else. It's 144% annualized returns. That's including all of the drawdowns. So all of the bullshit nonsense about Bitcoin's too volatile, it's a bubble, it's going to burst. That happens every cycle. People don't understand it's the duration of your investment that matters. If you have a long-term time horizon, those pullbacks are actually what you look forward to because you can buy more at cheaper prices. Or you can, if you want to, reduce risk from the cycle. I've done both, and I found, generally speaking, if you don't need to take lifestyle chips off, it's better to have the drawdowns and not try and time them, because I've done that too, and that's not the easiest one always. And it's also very difficult to put back in what you took out at the peak. You know, if you've taken out 100 grand at the peak and the markets are crashing, everybody hates crypto, you think everybody's going to prison, the last thing you want to do is put your 100 grand at risk back again. So you always do less, and you end up actually lowering your returns over time as opposed to adding to it. So you've got these assets that are cyclical, that have this incredible adoption rate that well in excess of the debasement of currency, which is crucial. And Bitcoin is the one. But let's first look at our asset management firm, XPAM, where we invest in a broad basket of crypto hedge funds. What we're trying to do within XPAM is capture the trend move from $4 trillion of market cap today to 100 trillion. That won't all be driven by Bitcoin. In fact, Bitcoin dominance over time will change. We're trying to capture the mega trend. That mega trend is so powerful because it's how you unfuck your future. Now, if you look at all of the assets on this table, what we've got is everything in orange here underperforms the debasement of currency. So you're actually getting poorer by owning small caps, REITs, treasuries, preferred, high yields, investment grade bonds, everything, unless you're using leverage. There's only a few. The SPY, well, really, that's in line with debasement plus inflation. So when we're looking at those, you've actually only got two asset classes: technology stocks and crypto. And within crypto, you've got these ridiculous returns where Bitcoin since 2012, we didn't go 2011, we didn't go back to 2010 or 9 because the numbers get too stupid, has annualized 130% with that 64% drawdown, 73% drawdown, and 56% drawdown. Ethereum is doing about the same, about 133%, and we expect it to outperform in this cycle as it has done in all of its cycles over time. And Solana is currently, because it's newer in its adoption model, has been outperforming Bitcoin. And then if we were to add SUI in here, which Julian and I are heavily invested in, that has outperformed Solana because it's earlier in network adoption, where you get the steeper part of the adoption curve.
Debasement is the silent killer in the global economy. GDP moves at 2% a year while fiat collapses closer to 10%. That gap is why housing is unaffordable, why salaries buy less, and why wealth escapes into harder assets. Technology has been one beneficiary, but Bitcoin has dominated it. And across every cycle, it has destroyed the performance of stocks, bonds, and gold. Now, let's go back to Rawl Pal as he continues his discussion.
So when you want to unfuck your future, you start to think about, okay, I've got crypto and NASDAQ. And I know a lot of you right now are all trading tech stocks because Bitcoin's been in this kind of sideways chop period. So you're all piling into tech stocks. Julian and I have tons of them in the portfolio. We love the technology trend. It's a really easy trade, has been an easy trade. But if you're honest with yourself, if you were to own one or the other, then you find that the NASDAQ has underperformed Bitcoin by 99.94%. What is the point of owning any other asset? This is the supermassive black hole of assets, which is why we personally are all in on crypto, because this is the big one. This is the greatest macro trade of all time. This is why many of the greatest macro investors of all time have moved across to crypto, because it is such a powerful trend with such powerful returns, and the cyclicality makes it also tradable. It's also the most powerful, the greatest macro trade of all time, because it's driven by network adoption. Remember, Metcalfe's law is driven by the number of users and the total value transacted on a network. Go back to Amazon, a perfect network adoption model. Metcalfe's law drives Amazon. People don't understand the valuations of Amazon back in the early days. You see, what happens is they had a number of users and they were only buying books. So the total value of transactions was low, but there was a lot of users. They started adding new products in. The value transacted on that network exploded. As they did that, the number of people using it exploded. That is what drives these incredible log charts of all the technology stocks. It also works in crypto. By the way, sorry, I forgot to mention before, we talked about this debasement versus earnings. That is why you see all these people, old school analysts, screaming about P ratios. P ratios are back to where they were in 2000s. Everything's going to crash. You don't understand. Earnings go with GDP growth, and price goes with debasement. P ratio always goes up in periods of debasement. That is how the world works.
Which is why valuations look expensive today, because prices are rising with debasement. Earnings are still subdued because the business cycle is subdued. So basically, all that needs to happen between now and next year is earnings need to rise to justify the valuation premium, which is already baked into equities.
But PEs will still go up.
Correct.
There's different valuation. PEs will go up, but it won't go up as fast. But it's been driven by this debasement trend. So, okay, let's go back to this chart. This chart is a killer chart, and everybody mid-curves this. This is total internet users in millions from 1992, when there was first 5 million users of the internet, and crypto users 2016, when there were 5 million. Now, we use wallets as active wallets as a proxy versus active IP addresses. Are they perfect? No. We all have lots of wallets. We all have lots of IP addresses. It is the direction and the rate of change that matters. The internet grew at 76% a year and then started flattening down to about 43% a year. That's very typical of network adoption models. Crypto has been growing at twice the speed of the internet. We will have 1 billion active wallets, and we can proxy that for active users. Yes, there's less active users. I get it. Doesn't matter. Don't get caught on mid-curving it. What it's saying is it's growing twice the speed of the internet. This is the fastest growing technology in all human history up until AI, which is dwarfing it already. But the difference between AI and crypto is you can't own crypto. You can't own AI very easily. And you couldn't own the internet. But here, you're getting a token in the infrastructure layer of the entire new internet, which is blockchain. And blockchain is not just about Bitcoin. It's not just about Ethereum. It's about all of the use cases of these various chains. We've seen the same with cloud compute, and that's split amongst tons of companies. Yes, there'll be some giants. There'll be some fast adoption. There'll be new use cases. It's all coming. And don't forget, here we're still in the speculation plus stablecoin phase. We haven't started really putting real world assets on chain. That's coming. We haven't even started putting Web 2 into Web 3. That's coming. That's a mega trend that will suck in the next rise. which is by 2030, we think we get to half the world's population having crypto wallets. Again, don't get stuck on the metric. What we're saying is the growth continues massively, and it will continue to massively outpace the internet. It's basically the future of the internet with different rails. It's the read, write, own rails of Web3 that will become increasingly important for things like digital identity, how AI agents interact, how the financial system operates, how the system of money operates, how collateral operates. It's all this. So this is the mega trend. This is why we're trading it. This is why it's outperforming everything. You need to understand Metcalfe's law. Okay, so we go back to this thesis at Xpan that we have that right now, crypto assets in total, all digital assets, are a $4 trillion market. Global real estate, 400 trillion. Global debt, 300 trillion. Global equities, 100 trillion, et cetera, et cetera. Gold, 20 trillion. Now, Bitcoin probably replaces gold. Okay, so we know where Bitcoin's going. But the rest of it is going to account for the other part of this equation. And that comes from this total market cap of the entire space. If we just use the same log adoption channel, which works in everything, and we've shown it, it tells you we get to 100 trillion in value by somewhere like 2032, if we just follow the fair value curve. So by 2032, 7 years from now, this entire space is $100 trillion. If we go above that one standard deviation, it gets there faster, or it gets to a higher valuation by 2032. So that is an astonishing opportunity considering we're only 4% of the way there. That's how you need to think about this. Then you need to think what is the structure of the crypto market going to look like? Well, Bitcoin will be the sort of percentage, let's say, that gold is of total assets. Well, total assets here is, somewhere close to, I don't know, if I'm looking at it, 500, 800, call it $900 trillion, and gold is 20 trillion. So Bitcoin will be somewhat similar of the new system. So what we're seeing is the game is yet to be played in much of the component parts of this. That's including the applications layer as well. Who's building what on this? This is what's making it such an incredible thing. 2023, we saw a large rise in the Treasury General account. And guess what? Crypto markets were sideways to soggy as they are today when this happens. But we're very near the peak. And Julian will come on to that in a sec. But it's a very crucial thing what happened because it was a big withdrawal of liquidity that happened fast. And crypto is the furthest out on the risk curve. So it's the marginal effect hits crypto more than anything else.
Yeah. And the TGA is recorded as a liability on the Fed's balance sheet. So as Raoul says, when it rises, it drains. When it falls, it's actually adding liquidity. And the way, I think part of the way to explain this divergence is if we just take into account that Bitcoin's market cap is around 2.2 trillion. This is a $500 billion drain. And we just assume, just for a second, hypothetically, that all 500 billion of this would flow into Bitcoin. Okay, that means that Bitcoin prices would be around 23% higher, right? If this TGA rebuild never happened. And so that would put Bitcoin, if we're looking at prices today, we're at around 111,000, 140,000. Now, again, it's unreasonable to assume all this liquidity would go there. But I'm just saying, I think if we take this into account, this explains partially.
It also explains why the year-on-year rate of change of global total liquidity,
we measure, has ticked down a little bit.
It's ticked down because it's the US rebuilding its general account. Now, again, we're not expecting M2 to be perfect. What we're saying is explaining is why it's diverging now. And it's not some other weird factors. It's the furthest out the liquidity curve and a bunch of liquidity has been withdrawn. And this is all to do with the debasement idea and how debasement flows through the system. So it's pretty consistent.
Yep. And the good news is, and I was hoping that we would already get the 9 today, is the DMARC indicators, Raoul and I have used for a long, long time. And unbelievably, they work well on economic data and macro data, liquidity data as well. And what you can see is that nines have typically been consistent with inflection points. Now, we're supposed to get the data today, and I'm expecting it obviously to go higher, just above, let's say, well, I don't know, it could be 0.8, slightly higher, but the point is we're going to trigger a 9 reversal. And the 9 reversal is exactly what triggered the reversal back in July, right? And also at the tops back in December of last year. So this should now reverse and work lower into year end, which then will drive our liquidity composites higher, coupled with the fact that the PBOC, so the Central Bank of China, their balance sheet's already at all-time high. So that's kind of what's offset liquidity. But this is what's impacted the drain, particularly in the US, and we believe is what is currently explaining this kind of sideways chop. But the point is that's all about to change, okay? Now, the next section I want to talk about is Bitcoin is a macro asset. Now, when Raoul and I first started working together, we were looking at this chart, and this is basically Bitcoin within a log regression channel. And the way to think about it is, the red line could be considered fair value. The gray lines +1, -1 standard deviations, which is what they are. And then the green lines are +2, -2
Just
standard
to add
deviations.
to that, these log regression channels work spectacularly well for these network adoption model assets like Bitcoin, NASDAQ, Google, Microsoft, Facebook. The whole lot of them all have the same kind of channel, and it works really well for, even overbought, oversold levels.
When you compare assets, honestly, the numbers are shocking. The Nasdaq has underperformed Bitcoin by more than 99%. That begs the question, why own anything else? Bitcoin and crypto are not another trade. They are the greatest macro trade of all time, built on the most powerful force in markets, network adoption. Metcalfe's law drove Amazon from selling books to dominating the digital economy. Crypto is moving twice as fast as the internet ever did. We are at $4 trillion today, but the path to 100 trillion is now much more visible than ever. If you want to stay ahead of these signals and know exactly when the market's heating up or when it's giving you those rare buying windows, I break it down every day in the Crypto Nutshell, my free 5-minute daily crypto newsletter. It's built to give you quick, actionable insights so you can make smarter decisions without spending hours buried in charts or headlines. You'll get clear signals on when to buy, when to take profits, and the latest news that could move markets, all delivered straight to your inbox. Just click the first link in the description, enter your email, and you're in. Don't pass up the chance to stay updated and make informed choices in the crypto market. Anyway, guys, I hope you all enjoyed today's video and that it gave you some value. I'll see you all in the next one, and as always, all the best.